Do you feel the stock market is expensive and that has you a little unsure? Well, what should I do? Do I continue to stay aggressive and hope the market continues to go higher? Or are you afraid that we could see a pretty significant downturn in the market because of how pricey it is and you want to find ways to protect on the downside? I've got a few potential ideas to consider. That and more coming up. There's lots of reasons to be optimistic about the stock market. There are, right? We are very early in, I think, what could be a revolution sort of taking place, a technology revolution taking place with AI. It's very scary. It definitely involves some existential risks here. But from a stock market standpoint or a company standpoint, the impact is potentially off the charts, and we're not yet really seeing that baked into companies' profits and performance just yet. We're seeing the investment and maybe some increased productivity, but not an enormous change. And I think that's possible. So there's a reason to be optimistic. Also, the Fed is starting to lower rates finally after taking so long, and connected to that, inflation. While there's concerns that inflation could go higher, it has been muted since the spike after we printed $5 trillion. So there's reasons to be optimistic about the stock market, but yet at the same time, for investors and for professionals, you also just have to kind of take a step back and say, can this rally continue to go? Now, there's a lot of statistics showing that, yes, it absolutely can. And the stock market is doing some things where in the past, as it's done those things, there's very, very high likelihood that a year later, the market's still going to be high. And yet, when you look at how the stock market has performed, let's just say since 2019, I know 2018, I remember it very vividly. The fall of 2018 was awful, and the year ended negative about 4%. But let's just take a look at the stock market, how it's returned since that time in 2018. 2019, large cap stocks, so the S&P 500, up 31%. 2020, yes, awful in so many ways, but it ended the year up 18%. 2021, stock market up 28.7%. 2022, yep, that was a rough year in the market, ended down 18%. But then 2023, the stock market was up 26%. Last year, the stock market was up 25%. And here we stand right now, at least heading into the fourth quarter, the stock market was up 14%. Guys, that is not normal. And this is coming from a big believer in the stock market and an optimist about investing moving forward. Guys, the experience that we have had, that the stock market has had, has been unusual. This is unusual. And what it's led to is the rise in the stock market, I would argue, and many professionals would argue, has gotten a little bit detached from the underlying economic activity. Said differently, and if you're a fan of the Wise Money Show, you know this is one of my go-to charts because I think it really illustrates a helpful story and helpful perspective. The stock market has advanced faster than earnings have grown. And earnings growth is pretty incredible by these companies, but that's how companies are priced. If you were to go out there and say, I wonder what Walmart's worth. I wonder what Amazon's worth. I wonder what Apple's worth. And yes, you can look at the stock market, but if you were going to nerd out and calculate it, you would calculate based on their earnings. Well, what's the profits and what are the projected profits in the future? And therefore, that will help you determine, well, what's this company actually worth? Yeah, that's how companies are valued on the stock exchange, publicly traded companies. That's how privately held companies and family offices are valued as well. What's the profit? And then a multiple of those profits. Well, take a look here. This shows the price of the stock market compared to those profits, compared to those earnings over the past couple of decades. The average is right there in the middle. Those dotted lines, that road, that's the average. And guys, that's a pretty wide range for the average, okay? So this isn't something that is just tossed around and moved around with the wind. That average for the past 30 years has been around 17 times profit, okay? And yet you can see the extremes. The extreme on the high side of around 2000, stocks were pricey. They were expensive. You were paying a high price compared to the profits or the earnings. Well, that was a tech bubble. Stocks were pricey. They were expensive. And then in '08, you can see stocks were cheap, right? The price you were paying compared to their earnings was very, very low. Well, here's where we stand today. You can see that double top there. Stocks got very, very expensive after we printed $5-6 trillion through it in the economy after COVID. Of course, that caused a run up in stocks and then this downturn in 2022. And here's where we stand today. Stocks have just surpassed that second highest expensive level that we saw after COVID. They are now second highest only to the tech bubble. Going back to where I started, if you're feeling the market's expensive, how do I stay exposed to the markets in case we are still early and because of all those reasons to be optimistic? But how can I do that? And is there a way to get some defined downside protection? There is. There is. If you're a fan of the Wise Money Show, you've likely heard me talk about using multiple strategies. And one of those strategies, depending on your situation, your risk tolerance, your age, your goals, it may be appropriate for you to add another strategy called hedging. These are newer tools to the exchange traded fund landscape. Newer, and we've been using them since 2019. Not everyone can get exposure to these types of tools, but it's an area of the investing world that is significantly grown over just the past few years because many people are saying the stock market's high. I need to continue to own stocks and appreciate on the upside. But boy, that downside risk is severe and it feels like it's rising. Is there a way to mathematically protect myself against some of that drawdown? And yes, these hedging exchange traded funds, there's lots of different flavors, but I'll just give you sort of the most common. The most common is that you can invest in a exchange traded fund that from 1 month, let's say October, that's the month that I'm recording this, from October of 25 to October of 26, okay, from October 1st of 25 to October 1st of 2026, you get to appreciate, you get to participate in the upside of the stock market, but up to a cap, up to a limit, and nothing beyond that, okay? But if the stock market goes down, you are protected against the first 15% decline, or you experience the first 5% decline and you're protected against the next 30% decline. There's a lot more flavors than that, by the way. That's typically where it started, but those are two of the most popular. So, for example, from October 1 of 25 to October 1 of 2026, if the stock market goes up 10%, you would be up about 10% minus whatever the fees are. If the stock market goes up 25%, like we've seen, right? That's extremely unusual. It hasn't been very unusual. If it goes up 25% and your cap is 12%, well, then you'd only be up 12. And you would have missed out on a lot of the rest of that return, but you would have hit that cap. If, however, the stock market is down 10%, well, if you had hedged away the first 15% decline, you would be flat. You'd be down your fees, but other than that, you wouldn't have experienced any of the market downturn. If the stock market then was down 16% and you had hedged away the first 15, you'd be down 1. If the stock market was down 20, you'd be down 5, right? So that's how that 15% hedging works. If you do the 30% hedging, and it's structured the way that I mentioned, where you experience the first 5% decline, sort of like a deductible, but then you avoid the next 30, that has a similar upside cap of, say 12% or so, but I'm not talking about any specific product, it's just in theory. But then if the stock market goes down, say it goes down 10%, you'd be down 5 plus fees. If the stock market was down 30, you'd only be down 5 plus fees. But if the stock market was down 36, you'd be down that first 5 plus another 1%, you'd be down 6 plus fees. These types of tools, they are unique. They are not for everyone and they are extremely complicated, but they have definitely become more popular and more desired by especially pre-retirees and those in retirement. These types of tools can be ideal if you're doing a personal pension plan in retirement for that intermediate term bucket, where you get to participate in some of the upside while you have a more defined experience of what your protection would be if the stock market caught a cold. These are not for the faint of heart, though. Like, there are serious drawbacks, because pretend that you were using these during this stretch that I just shared, 2019 and 2020, so you would have capped out. You would have missed a lot of the upside if you were using these sorts of tools. So there's some significant risks or opportunity cost to these tools, but if you're looking at the stock market saying things are pricey, Things are expensive. How can I stay invested with some of the dollars and yet have some defined downside protection? Work with your certified financial planner. See if a tool like this could make sense for some of your dollars. If they're not a certified financial planner, I would be cautious about using these because you want to make very, very sure you know exactly how much of this sort of tool you should use, because it's got to make sure that it fits within the context of your financial plan. All right. So that's a little bit of that hedging strategy that I've talked about in the past and helps you protect against some downsides, potentially protect against some downsides of the markets as the market continues to get pricier and pricier. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.